How can private investments improve investor outcomes? Hi, I'm Dan Reyes. In this video, I'll explore how our team is thinking about private investments and what they can mean for your clients. I'll also talk about Vanguard's approach to thoughtful product development and provide an example of our philosophy in action. We have a deep conviction that access to the top managers in private investments has the potential to meaningfully improve client outcomes. We stepped into a collaboration with HarborVest back in 2020 and started serving clients across Vanguard with a private equity offer. Most recently, we announced a collaboration with Wellington and Blackstone to continue deepening our efforts in this space. We think that there are multiple benefits to private assets for the right clients. First and foremost, the primary benefit is that they present the opportunity for higher return driven by alpha and liquidity risk premium. Access to top tier managers at reasonable fees, even in this space, is essential. We all know that no index option exists and that manager risk is higher than with public asset managers. What that effectively means is that manager selection requires rigorous due diligence, especially because the dispersion of returns is different within privates relative to active public. The secondary benefit of private investments is that provide the opportunity to improve diversification, and diversification in the sense that it expands the investable market coverage significantly while also being exposed to similar systematic risks like public counterparts. This means that when you think about it, it's not a truly distinct asset class, just another delivery mechanism, private and public alongside each other. And private assets represent a material share of the investable markets. Whether you're thinking about equity, credit, real estate, infrastructure, it's an area of exposure that most investors don't have access to. But it's also important to note that when you think about private investments, you have to think really carefully about whom this is suitable for. You have to think about the end client's time horizon, their risk tolerance, their liquidity constraints. These are all key for identifying who they might be appropriate for. And we think that Vanguard's client focus, brand, and scale make us uniquely positioned to deliver private market exposures to our investors. In doing this, we also acknowledge that private investments are new or will be new for many individual investors. We and the industry need to invest in educating clients to help them understand the difference between privates and the investments that they're used to. But I'd also say that this isn't a process that's new for us. We're excited about the opportunity to expand access to traditionally institutional focused strategies, much like we did back in 1976 when we introduced the first index mutual fund. As advisors think about private investments, it's really important to focus on the concept of manager selection. You often hear about the term of return dispersion being different in privates relative to public, with the idea being that in privates, the best managers do really, really well, and your average managers oftentimes perform in line with the market. That means that as advisors are stepping into private markets, they're going to have to think really carefully about whether or not they have the resources and the skill to think about manager selection. At Vanguard, we've got a team of over 20 people who are focused on thinking about managers every single day. It's the heart of what they do. The other thing that advisors should be thinking about is what is the investment benefit, especially in terms of diversification. Oftentimes, when a private asset manager talks about the benefit that they can bring to a portfolio, they're often touting diversification. But an advisor has to think really and truly about whether or not that's true diversification or diversification because asset values aren't marked as frequently as public investments. Our own investment teams and our research teams try to think deeply about that. And to compare apples to apples, we often look at de-smoothed returns. We're thinking about how you get privates and publics alongside each other so that they work harmoniously in the portfolio and you have a true representation of the benefit that they can bring. At Vanguard, our portfolio review team takes a disciplined and thoughtful approach to product development that is different by design. Every new investment offering has to meet a high bar. It has to be enduring, sound, and most importantly, aligned with our clients' long-term needs. This often means that we aren't chasing trends, but instead we're focusing on thoughtful innovation that's grounded in our mission. A great example of this philosophy in action is how we've approached active ETFs. We've been managing active strategies since 1975. We have deep capabilities across fixed income and equities. But when it came to bringing these strategies into an ETF wrapper, we didn't make the decision based solely on how the market was moving. We took our time. We studied the risks like daily transparency, the inability to close a fund. We worked closely with our internal and external managers to ensure that we had the right structure and safeguards in place. That work led to the successful launch of several active ETFs, including Core Plus and High Yield most recently. And in August, we announced our intent to launch 3 active equity ETFs in partnership with Wellington before year-end. These strategies are similar to the ones that we've used for our flagship offering and are now being brought to market in a format that meets clients where they are without compromising on quality, discipline, or cost. Be sure to like this video and subscribe to this channel for more insights from Vanguard's thought leaders.